Jan, let me first ask you about Larry Summers' speech yesterday. I think it's one of the most exciting things that come out of the conference so far, because he seems to be trying to convince central banks around the world that it's more important to work on employment, which is not, of course, the ECB's primary mandate, and less important to worry about inflation, which is historically something that the ECB is very concerned with.
Yeah, we have our primary mandate, and it's in law, in European law, and it is price stability. So we should stick to that and try to get there. Also because we are convinced that price stability is the best contribution we can make to economic growth. But if anything, I learned also from Summers' speech that if the real interest rate, what we are calling the natural interest rate, is going down because of a number of factors like aging and others, I would say that the need to get to this inflation objective, this price stability objective, and to maintain the proper monetary accommodation in order to get there, as we are doing, is even greater, because since the real component in the interest rate is going down, the risk of getting to this zero lower bound is even greater. And that's why we absolutely have to anchor inflation expectations, get back to this, or get to this inflation objective of under 2, but close to 2%, in order to then be able to have interest rates later on back where they, let's say, belong in a natural way.
But what could you possibly do? I mean, the ECB has already tried an incredible amount of bond purchases in the quantitative easing program and lowered rates to below zero. None of it has worked to bring inflation to Mario Draghi's target. Now that you're sort of taking your foot off the gas pedal, as he indicated in Riga, how can you possibly spur inflation any higher?
No, we are pretty confident. First of all, I think that our policies did work. QE and all the other measures, zero interest rate, negative interest rates, everything we have been doing, it did work. It did add to economic growth, and it did add to inflation. And it did get us in a position now that we are pretty confident that this convergence of inflation towards our target will continue. And we are that confident that we could decide to announce the end of the asset purchases, keeping, that's true, ample monetary accommodation, but through other measures, reinvestment of the paper which comes to maturity, and also a very strong forward guidance as far as interest rates are concerned.
Let me ask you then a question from the other side of the lens. After this incredibly accommodative period of incredibly accommodative policy, and we're still in the midst of it, actually, are you concerned that any asset prices have gotten out of hand? Paul Tudor Jones the other day said it is due to this interest rate policy that you've seen, housing prices, market prices rise to levels that need to eventually revert back to a mean.
Yes, but we are monitoring this. First of all, according to me, there is no fundamental inconsistency between our monetary policy objective of price stability and everything we are doing in order to get there, and on the other hand, pursuing financial stability, because you need monetary stability and you need price stability and helping the economy to recover in order to have a sound financial system. So there is no, you cannot have a sound financial system and financial stability if the economy is not growing. But that being said, it's true that an environment of low interest rate can create some search for yield and perhaps some bubbles, but that's that we are seeing locally, and that we should address with local instruments, as we are doing in Belgium.